right. Today's Tuesday, November 11th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. How about we begin? I was joking last week when I said that if we had the signs of the apocalypse, I mean, some of you understand the reference 15 signs of the apocalypse. But now I'm taking it a little bit seriously. We're talking about the signs of the market's doom. Sign number 1, the return of the Big Short. Sign number 2, the election of Mamdani in New York. Sign number 3, Jensen Huang, CEO of Nvidia, warning that China is going to win the AI war. Sign number 4, the retirement of Nancy Pelosi, the greatest insider trader in Washington, D.C. Sign number 5, Scam Altman asking the government for a backstop. And sign number 6 is what we got today. Masayoshi Son from SoftBank announced that he dumped Nvidia. And you folks are feeling that the tide is changing. The narrative is beginning to collapse. The pumping narrative is what I'm referring to. You're beginning to see and hear more and more voices questioning the AI narrative and the mania behind it, calling it a bubble, beginning to examine the nitty-gritty of financing in this AI bubble and finding the warning signs. You're beginning to hear and see more of that every day. And this is exactly what we're going to talk about in tonight's program, because there was a really good article in the Market Watch talking about the financing web in this AI bubble. Because, believe it or not, despite the thumbnail of the video, we're not going to talk much about SoftBank dumping Nvidia, although it's a warning sign, but we're going to talk about the web of financing surrounding Nvidia and the AI mania. And you will begin to understand the risk in this AI bubble, because you have a lot of folks saying that, oh, this time around we have major names, companies with real revenue and profits. So we don't see the same risk that we've seen before in the real estate bubble or the dot-com bubble or in the 1920s bubble. All of these examples were led by weaker companies with no real revenues, no real profits, but this time it's different. And the purpose of this video is to show you a little bit of a taste, because we're going to expand on this conversation again in another video, but I will show you a little bit of a taste from this article that the danger is not about the reliability of the financing of these companies. We know they're all giant technological behemoth. They make a lot of money, but it's their entanglement with other companies and with funny financing methods that would lead to the pop of this AI bubble. And without further ado, let's just dive right into it. Here it is, in focus tonight. The spider web of financing in this AI bubble. And today we got a major warning about it from SoftBank, announcing that they've sold the entirety of their Nvidia stake at $5.83 billion. Of course, they've done that last month, in the month of October. It is an alarming sign for two reasons. Number one, SoftBank is investing in a lot of Nvidia competitors, a lot of startups in AI. And they're probably seeing signs that Nvidia is losing its monopoly over the AI chips, not just from domestic competitors, but perhaps from Chinese competitors. And today we heard the announcement from AMD that they're seeing more and more demand for their chips. That begins to crack and break the pricing monopoly of Nvidia. The second reason why this is problematic, because SoftBank is actually using the cash to go all in on OpenAI, Scam Altman. And we know that Scam already asked the government for a backstop, aka a bailout, in case he can't fulfill his obligations, because the entirety of the bubble is built up on OpenAI Scam Altman ability to raise trillions of dollars to pay all of these massive technology companies. And that's not going to happen, so he's already looking for a bailout. He's claiming that he's too big to fail. If he goes down, we all go down with him. So we have to bail him out. And unfortunately, he is right that OpenAI right now is too big to fail, because it's going to blow up the economy. Should we bail it out, though? I say burn it the fuck down. They have to face the consequences, and anybody who's not paying attention right now and then says, oh, Scam Altman went down and now the market went down, my 401k went down, what am I going to do? Well, maybe you should have been aware right now, this moment, and taken action right now, rather than waiting for the shitstorm to hit and then saying, hey, we got to bail out Scam Altman, because if he goes down, I go down. Regardless, the investment by SoftBank putting all of their eggs in one basket is problematic, because we already know that, I mean, you look at ChatGPT, at OpenAI, what is the point at the end of the day? What is the model? They're going to spend all of these trillions of dollars to give us ChatGPT for $35 a month? Okay, that's the same model of Netflix. What is the big deal? Why are we fluffing the valuations? Oh, ChatGPT, when you're lazy to do your own shopping and you ask a question, they're going to refer you to Walmart they're going to give you a link to Walmart, and once you click on that link and you buy stuff, ChatGPT gets a kick from Walmart. Oh, big deal. Wow, let's fluff up the valuation by trillions of dollars because of that. This is not the internet, which was a new medium of doing business. It was way, way bigger than AI in terms of the potential that we're seeing right now. And even with that, the dot-com bubble went bust. And furthermore, OpenAI is already losing the enterprise section of the AI business to Anthropic. And we're probably going to see more and more companies. But even in the enterprise side of the business, in AI, you're going to charge companies per employee to use your AI model? Okay, big deal. That's just a different cloud company. It's the same business model as the cloud company is doing right now. Where's the transformation that's going to produce billions and trillions of dollars from AI? It's just a gimmick at this point. And they're risking trillions and trillions of dollars for it. And if they go down, we're all going to go down with them, except those of us on the ark right now. And we are in the middle of the desert, and everybody around us is saying, hey, you guys are crazy. We've never seen a flood in the desert until it happens. So the time to prepare for the collapse of the AI bubble is right now. And here's one of the major cracks that will take down this bubble and collapse the economy down with it. This is a really good article that was published by MarketWatch. I'll give it 9 out of 10 because the flow was not precise. I had to change a few stuff in terms of order to get the article to flow a little better, but I'm going to read it for you and give you my 2 cents. And here it is. It reads, big tech needs a staggering $1.5 trillion to fund the AI boom. This is the complex playbook it's using to get it. We're going to do a lot of reading here, folks, so buckle up your seat belts and pay attention, at least try to. In a rural Louisiana parish that is home to some 20,000 inhabitants, an army of bulldozers and excavators has been busy clearing a vast patch of farmland. In other words, destroying the environment for what? It is the next frontier of the artificial intelligence revolution. It is where Mark Zuckerberg and Meta Platforms Incorporated have chosen to build the Hyperion, an AI supercomputer housed in 9-building campus of data centers humming with the latest Nvidia semiconductors, chips, and equipment to help pay for the Manhattan-size data center. What the f***? Zuckerberg has turned not to big banks like JP Morgan Chase or Goldman Sachs that have helped finance previous American industrial expansion, but rather the alternative asset manager Blue Owl Capital, funded by institutional investors such as pension funds and insurance companies instead of customer deposits. Why is this important? It's important because there are regulations on how much risk the banks can take in certain sector exposure. So if Meta and Amazon and Google and all of these companies want to take trillions of dollars worth of loans to build all of these data centers from Goldman Sachs or JP Morgan or Barclays, they can't do that because there are regulations that the banks should not have too much exposure in one sector. And that is, of course, as a result of the real estate bubble bust that happened in 2008, 2009. So the problem here is that they're going to alternate financing schemes using companies that are not really proven. We don't even know what the hell they're doing. Blue Owl Capital. They're funded by institutional investors, pension funds, and insurance companies. That's how the dominoes fall. So in this financing scheme, suppose demand goes down, or we have a flare-up in inflation or recession, or anything that really stalls the development and the demand for these massive data centers, then Blue Owl Capital goes bust. And then who goes bust after that? Whoever is backing Blue Owl Capital. The pension funds, I mean, do the retirees know that their money's going to this kind of financing scheme? Pension funds will go down, institutional investors will go down, and the insurance companies backing this deal will go down. We continue reading here. Hyperion will be built and owned by a $27 billion joint venture, with Blue Owl Capital managed funds taking an 80% stake, and Meta holding 20%. In other words, if this scheme goes bust, Meta is going to be obligated for about $5.5 billion worth of losses, but Blue Capital will be obligated for the rest. And do they even have any backing or financing behind it? Of course not. Blue Owl will fund a portion of its contributed capital through debt issued to PIMCO, here's another entanglement, and other institutional bond investors via private securities offering. So now PIMCO is entangled in this scheme. If this project goes bust, they don't get paid. They have to eat a loss. Meta will lease the facility upon its completion in 2029, its largest private capital deal that it has ever done in Wall Street. And by the way, here's the weekly chart for Blue Owl Capital, OWL. Classic topping head and shoulder formation, and it's about to collapse already. You look at the credit default swaps in these kind of facets, they're spiking and surging significantly higher, indicating that there is a high risk of default. We continue reading the article here. AI has the potential to completely transform the world. But first, it needs a few $1 trillion. Out of the estimated $2.9 trillion in AI capital expenditures expected by 28. The hyperscalers, as they call them, building the technology, including Meta, Amazon, Google parent Alphabet, Microsoft, and Oracle, would only generate enough cash to cover $1.4 trillion, according to Morgan Stanley. I would actually say less, because right now we're assuming that everything is going to stay the same. Nothing is going to change in the variables in the economy. What if it does, though? Then they're going to generate less and less revenue. They're not going to be able to even cover the $1.4 trillion, and then they're obligated on the rest that they're raising via debt. And here's how they get the rest. To get the remaining $1.5 trillion, big tech companies will need not only to utilize traditional debt instruments like corporate bonds, but also carry out feats of financial engineering that will fundamentally redefine their relationship with Wall Street and pull the entire market along for the ride. Not the kind of ride you want to be in, by the way. It's the kind of roller coaster that goes down and then snaps out of its brackets. The article continues. There are existing tools to fund capital expenditure cycles. The rise of high-yield bonds in the 1980s democratized the public debt market, allowing non-investment grade companies to easily raise capital. In the 1990s, telecom companies engaged in vendor financing, lending money to their customers to help fund purchases. And a lot of that ended in a disaster, by the way, so this circular jerk-around financing is not a new phenomenon. It actually happened in the 1990s. Some of you might remember Nortel, with the circular financing along with Cisco, and then a lot of these companies were exposed as fraud. They were doing accounting fraud, so that brings up the conversation of now Michael Burry, accusing the largest companies in the world, the hyperscalers, of fraud, accounting fraud. I mean, Cisco was a legitimate company, but it went down either way because of their entanglements with these fraud companies. Now we're talking about Meta, we're talking about Nvidia, we're talking about the biggest companies in the world being engaged in fraud. We'll wait and see, of course, what Michael Burry is going to reveal. But you can see here a company like Meta raised $30 billion in high-grade corporate bonds recently. And again, everybody assumes that the debt is secure because Meta's never going to go down. It's always producing a lot of revenue. But again, we're talking about a technology company that could be disrupted in the AI age. If their investments go in the wrong direction and they invest in the wrong things, they're not going to be the future of how this technology is going to work and evolve. It doesn't matter what the valuation of the company right now, what kind of financing they have, what kind of revenue they produce or profits. They can go bust too. So again, we talk about the entanglements. If something begins to hurt Meta, like Blue Owl Capital, and now they lose $5.5 billion, and then they lose another $10 billion with another entanglement. Little by little, you begin to see a problem in their own bonds. We will begin to see a spike in credit default swaps. And at that point, the stock is already down 50%. Don't underestimate just because the company is large and doing well right now, that it's going to do well and continue to hold the same status all the way to 29 or 30 or whatever they're kicking the can down the road to. Let's continue. To avoid depleting their own free cash flows, the money available to reinvest back into the business or distribute to shareholders. The hyperscalers are looking for novel ways to finance their data center build-outs. Meta's minority stake in its Hyperion joint venture will appear as a, quote, non-marketable equity investment on its balance sheet, according to the latest quarterly filing. Why are they doing that? They want to avoid scaring investors into catching up that Meta has a lot of debt entanglements that could produce a lot of risk for the company's future. So they just write it off differently, thinking that we're all stupid. But here's the reality. That means the debt is not consolidated on Meta's books. Instead, it sits with a special purpose vehicle. When was the last time we've heard this terminology? Some of you might remember the real estate bubble back in 07-08. Special purpose vehicle. And Wall Street is eager to service these investment-grade tech behemoths, seeing them as extremely reliable streams of income. For now, for many companies in this web, AI has become an existential investment. Michael Green, the portfolio manager of Simplify Asset Managers, said, "The winners could reap trillions, while the losers face obsolescence. So think about maybe Meta surviving, catching maybe $5.5 billion downside, but then Blue Owl Capital goes bust along with its investors. But who the hell knows who are these investors, where they're coming from, and what are they investing in? Because they're going to have to sell those assets to cover this loss. And it just keeps going. The dominoes keep falling. By using borrowed money instead of cash, you're magnifying the outcome when you win, Green said. But he added that comes at the cost of amplifying the downside if you lose. Bingo. And the problem is win or loss is not really dependent on the execution by these companies. It is in most times dependent on external factors of the economy. We see what's going on with the consumer status. We see what's going on with the stagflation in the economy. So you hear this on TV all the time. They say, oh, but these companies are executing pretty good. Who gives a shit? At the end of the day, if the economy goes bust and the consumer continues to get weaker and there's no demand in the economy, they're going to have to stop a lot of these projects. And then we're going to see a lot of companies, a lot of these vendors in this web of entanglement going completely bust. And here's my favorite, a company that I think will go down to zero. CoreWeave, the largest net cloud company, which was down about 16% today, by the way, counts Microsoft, Meta, and OpenAI as its top customers. But before it was a multi-gigawatt power broker to the world's biggest tech companies, CoreWeave was a small crypto mining company started by 3 commodities traders in 2017. Of course, then Nvidia, there's a lot of fraud in how CoreWeave became the company that it is right now. Nvidia wanted to solicit that initial demand for their chips, so they had to take over this company and create the fake demand where they buy their own chips. I mean, they're investing in CoreWeave, then CoreWeave take the money and invest in buying Nvidia AI chips. Anyhow, CoreWeave's rise from a New Jersey garage full of chips to a neocloud leader with 33 data centers across 2 continents wouldn't have been possible without its unique relationship with Nvidia. By 2021, CoreWeave had become Nvidia's most trusted and specialized cloud partner. Where did they get the money? From Nvidia. That's how they got to be a partner. Anyhow, giving it early access to Nvidia's latest chips, Nvidia invested $100 million in CoreWeave in 23, when the latter was still a fledgling private company. The chip giant went on to serve as an anchor investor in CoreWeave's March 2025 IPO in October, so they have a stake in CoreWeave. Just understand that if CoreWeave goes down 16% as it did today, that's going to hurt Nvidia. If CoreWeave goes to zero, then imagine what's going to happen to Nvidia. And if Nvidia goes down, imagine what's going to happen to the ETFs. Every ETF has the largest weight right now by Nvidia. The retirement funds, all pretty much invested in the ETFs. Nvidia goes down because CoreWeave goes down, then the ETFs go down, and the companies behind these ETFs go down, and then the retirees invested in these companies and these ETFs go down. You see how it's working here, folks. You see how the dominoes fall. The danger can be isolated if we have no entanglements. But in this bubble right here, we have a lot of financial entanglements in the web that if one goes down, everything goes down. Continuing, in October, a 23 agreement stating that Nvidia obligated to purchase up to $6.3 billion of CoreWeave unsold cloud capacity until 2032 was publicly disclosed in a securities filing, meaning that they're obligated for CoreWeave's unsold capacity to the extent of, here it is, Nvidia currently holds 6.6% stake in CoreWeave. It is a symbiotic relationship. CoreWeave receives financial backing to support its capital-intensive business, and Nvidia secures an important distribution channel for its technology. CoreWeave did not respond to a request for a comment because they're fraud. And you know, they keep attacking the short sellers and the bears that, oh, you don't believe in AI, you don't believe in America. Shut the f*** up. We don't believe in stupidity, and excess greed is what it is. So here, in the Maverick of Wall Street, we've shorted CoreWeave back on October 24th at $130 a share. And this is the chart that we gave you in the morning brief that I think the CoreWeave is going to go down to 90. That's my first target of the short. Here's the update. Boom. We're down at the target right now and then some. And since we initiated the short, CoreWeave is down about 32%. Meaning if you shorted $1 million, you've already secured about $320,000 worth of profit. Let's continue in this web of entanglement. Following in CoreWeave's footsteps, TerraWolf, the ticker WULF, which was down about 13.5% today alone. In Cypher Mining, CIFR was down about 5% today. We're short Cypher. We're Bitcoin mining businesses. So they hoarded a lot of GPUs to begin with. So Nvidia and a lot of other companies figured out, hey, you might want to rotate toward becoming an AI data center instead and make a lot of money. So they recently pivoted to building and leasing out AI data center facilities. As it turns out, running AI workloads is much more lucrative way to use GPUs than mining cryptocurrency. In the last 3 months, both companies separately entered into a 10-year agreement to host the private new cloud company FluidStack. TeraWulf lost $132 million and Cypher lost $71 million in the 12 months ending June 30, according to FactSet, making it difficult for them to raise money to build the infrastructure needed for their agreements with FluidStack. Oops. But as evidenced by CoreWeave and OpenAI, companies in the age of AI need not to meet profitability prerequisites before entering into financial contracts. Gee, how would that end? Here it is, as long as a big tech company is willing to co-sign for them, like a wealthy parent helping a child secure a mortgage. I was going to say, back in college, when you wanted to lease an apartment, you had to have a co-signer. Your parent, your aunt, somebody. And then, of course, you throw a lot of parties, you trash the apartment, you get kicked out. And they end up holding the bag and their credit gets screwed up. So this is exactly what's happening with these big companies. Again, it's not the problem with these big companies, Meta, Amazon. We know they're large companies. They produce a lot of profits, a lot of revenues, got it. But it's this kind of shit that they're getting into right now that's going to blow them up. We continue in what is called equity wrap. Google, aka Alphabet, the world's fourth biggest company, agreed to backstop $3.2 billion of FluidStack's obligation to TeraWulf and $1.4 billion to Cypher, receiving warrants to purchase equity stakes in the miners in return. Here we go. Why would you do that? Now you're obligated. If these guys go down, you're going down with them. No wonder why Scam Altman is now looking for the government, because at some point when the dominoes fall, these big companies backstopping all of this crap not going to be enough. At some point you need the government to bail them out by printing trillions and stealing, really effectively, trillions out of the pockets of taxpayers to bail out all of this irresponsible risk-taking by these companies. Under the agreement, Google will pay TeraWulf and Cypher up to the predetermined amount if FluidStack backs out of these data center leases, reducing the risk for the miners. But remember, Google is going to lose $3.2 billion, and that these companies, they have debt obligations themselves. So whether they get a backstop by Google, once the project collapses, their other loan obligations will begin to hit. They're going to begin to default in other assets. And it would not matter if Google is doing a backstop of $3.2 billion. It's not going to matter. It's not going to be enough to plug the hole. Anyhow, that is exactly how TeraWulf became the first ever crypto miner to raise debt in the high-yield corporate bond market last month. Here we go. And again, PIMCO, somebody is entangled here in this issuing of the high-yield corporate bond. The move could kick off a trend of data centers funded by junk bonds. Debt issued by companies too financially shaky to be rated investment grade by the rating agencies. In the biggest junk bond sale since the landmark 1989 leveraged buyout of RJR Nabisco, TeraWulf issued $3.2 billion worth of bonds to finance its data center build-out in upstate New York. Notably, the same amount as Google backstop. Something is fishy here. Why would they need the financing if Google has a backstop? While rating agencies were debating the bond's placement on the junk scale, Google's guarantee de-risked the offering enough to secure a BB rating from Fitch, positioning the issuance on the most creditworthy side of the junk spectrum. This is exactly what happened, by the way, back in the real estate bubble. You had certain bonds that were rated BBBs or BBs. It looked good in paper, but again, they were backed by other junk bonds. And as the late and great Charlie Munger once said, if you mix turds with raisins, they're still turds. And of course, TeraWulf and Cypher Mining did not respond to requests for comment because they're frauds. That's why. And pay attention now, because we're going to begin to dig deep. CoreWeave is a cautionary tale. It's been able to raise debt rapidly, but even with the financial support of Nvidia, the strategy has come with high interest rates. D.A. Davidson analyst Gil Luria sees CoreWeave's debt level as a key financial risk. He highlighted in a note last month that the company's interest expenses, pay attention now, are outpacing its operating income.
Oh, hell no!
meaning the business does not make enough from operations to pay its lenders. This is going to be a big problem because a lot of these AI initiatives are not producing revenue yet, are not producing profits yet. And on top of that, it seems that interest rates, despite what the Fed is doing, at least in the long end of the yield curve, that's what really matters at the end of the day. Those rates continue to go higher. They're not budging even with the Fed continuing to cut rates. So what happens if the CPI goes up and all of a sudden the 30-year bond yield continues to spike? All of a sudden the interest expense for these companies will continue to pile up. And if they're not making money from operations, it's just a matter of time before they go bust. Luria anticipates the situation will worsen, as CoreWeave is expected to take on more debt to finance its expansion. As of June 2025, CoreWeave's weighted average interest rate on short-term debt was 12.3%, up from 9.6% 6 months prior, according to the company's filing. As a result, Morgan Stanley anticipates that corporate bonds issuance will only account for around $200 billion of the $2.9 trillion global spending on AI from 2025 to 2028. The absence of AI-driven revenues seems to be contributing to this trend. If and when big tech companies drive more AI-related revenues, we think investors will have clearer line of sight to facilitate unsecured debt issuance. Here's the problem though. Where is the revenue coming from? Is it going to be AI robots buying shit from AI, doing that circular jerk around financing again? Or is it going to be real human beings and customers? Who are now, by the way, as we found out today, the payrolls from the ADP estimated that the private sector of the economy was shedding 11,250 jobs a week in the month of October. Who's going to do the spending? Where's the revenue coming from? The consumer is broke and they're losing their jobs to AI, so who the hell is going to produce that revenue? Let's go back to the article. CoreWeave has been another prominent participant in the private credit market. CoreWeave's securities filings showed that in 23 and 24, alternative asset manager Blackstone and CoreWeave's largest shareholder, Magnetar Capital, some of you might remember, which played a role in the collateralized debt obligation market in the period leading up to the housing crash. So now you got Magnetar and Blackstone getting entangled in this circular web of financing. Anyhow, Magnetar created financing agreements for CoreWeave to receive streams of capital from special purpose vehicles. Here we go again. The loans are collateralized by CoreWeave's GPU and networking equipment, and Blackstone and Magnetar have the option to seize ownership of the SPVs in the case of a default. CoreWeave's 2024 loan of $7.5 billion was one of the largest private debt issuance at the time. And this is why I've been saying, folks, that there is a debt bomb that is about to detonate, but it's going to be in the private market, not the public market. So you're not going to even see it coming. So you have to look at these warning signs and take them seriously, because once the blow up happens, the dominoes will fall so fast, it's going to be too late to prepare. It's going to be too late to save. Anyhow, CoreWeave's credit rating is squarely in non-investment grade territory, and using GPUs as collateral introduces additional risk if the equipment useful life is shorter than expected. Wow. So you might say, oh, it's all safe because if they go bust, Blackstone is going to assume the equipment and the chips as collateral. What if these equipment become obsolete because we have new technology? What happens to Blackstone at that point? Anyhow, but once again, big tech co-signer lends credibility. Sheen Cray, a vice president and senior analyst at Moody's, wrote in May 2025 that Nvidia's close relationship with CoreWeave provides credit support. Who gives a shit? At the end of the day, when the shit hits the fan, Nvidia is going to run so fast and say goodbye, CoreWeave. We don't even know you. We'll pay whatever we're obligated to pay. We'll lose whatever we're going to lose, but that's it. You're on your own right now. The entrance of hyperscalers has brought increased legitimacy to a private credit industry that has traditionally lent to financially shaky companies. Big tech's existence battle for AI dominance, aka FOMO, is shaping up to be an unprecedented bonanza to alternative assets. And how's that going, by the way? Today I tweeted that CoreWeave will go bust. Zero. You see the credit swaps already, the 10-year credit swaps on CoreWeave, they're skyrocketing right now. They're moving up significantly higher because investors are now beginning to buy insurance against default. How many warning signs do you need? You see how all of this stuff is the real danger. It's not about the scale of the companies or whether they have revenues or profits. It's the entanglements, moron. And on top of that, Oracle is another disaster. I mean, you see the AI data center issuance of debt went bananas in 2025. Now, these companies, Amazon, Meta, Microsoft, all of these companies are known. People love them. They invest in them because they're safe. Why are they safe? They produce a lot of revenue, a lot of profits, and they have very little debt. But now, all of a sudden, their debt continues to expand. They're becoming heavily debt companies in the age of stagflation where we have high interest rates. And you could say, oh, the Fed is going to cut rates. Well, they've been doing that, and interest rates haven't really budged. They've been going higher. Now, the problem with Oracle is they have a lot of long-term debt to begin with. They have over $90 billion worth of debt, which is for the company's size is too much for the kind of revenue and profits they're already making. On top of that, they're adding billions and billions of dollars on loans so they can build the stuff that OpenAI is going to buy from them someday. What if OpenAI says, our investors backed out? We don't have the cash, Oracle. What happens to Oracle at that point? And this is why you see the credit swaps, the 5-year CDS for Oracle, also beginning to skyrocket again, indicating that the default probability is getting higher. And this is why back in October 29th, we shorted Oracle at $283 a share. And we showed you this chart right here in the morning brief a couple of days before. And I said that the target is going to be a pullback in Oracle all the way to closing the gap at 241. Here's the update for you. We got it, 241. And since we shorted Oracle, it's down about 16.5%. Now, I think that Oracle is going to rebound, an oversold rebound coming soon as tomorrow. And explain that to you in the options market coverage and the charts analysis. But we're done with phase number 1 of the short, but it's not over yet. Oracle is going to be one of the biggest collapses we've ever seen before because it is impossible. If the company continues in the same path, it will collapse. Imagine a company the size of Oracle going bust. What is that going to do to the market, to the economy, to the retirement accounts? Think about that for a moment. And on top of that, I mean, you see the debt issuance, the high yield, aka junk bond, they're now ramping it up. And again, in the age of lower interest rates, it was okay, but now we have the era of high interest rates, and there is no guarantee. The Fed can cut rates in 26. The White House can have their own stooge as the Fed chairman. And they keep cutting rates. If that inflation goes higher, and there are a lot of warning signs, the tariffs will begin to show inflation, and the monetary induced inflation will begin to show up if they continue to cut when there is no need for a cut, when they continue to ease when there is no need for an ease. Well, rates will continue to go higher, increasing the default probability for a lot of these junk bonds. And this is how, folks, just a little window, a little peek of this circular web of financing that is happening right now in the AI mania that will not only impact the smaller companies at high risk, it's going to go as far as the largest companies in the world, the pension funds, companies like PIMCO, like Blackstone. When you have the dominoes falling at this scale, we're talking about trillions of dollars being wiped out of the economy. We're going to have to do the biggest bailout we've ever seen. Trillions and trillions and trillions of dollars to stop the bleeding. What's going to happen to the credit worthiness of the United States after that? What's going to happen to the value of the US dollar after that? I want you to think about that because we're going to continue the conversation in another video about the economic future of the United States. That should come out this week. But for now, this wraps up part number 1 of the daily coverage. But rest assured, part number 2 is coming out right after this video. We're going to talk about the market coverage, the charts analysis, the options market analysis, heat map analysis, and everything between. This is going to be members exclusive, so if you happen to be a member, make sure that you're going to check out that video. You're going to leave a link in the comment section. If you're not a member, consider joining us, folks. You have the join button here on YouTube. You can have links in the comment section so you can join us via Patreon if you don't want to use YouTube. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and I love all of you. Happy Veterans Day and good night.
Oh, they expect one of us in the wreckage, brother.
Have we started the fire?
Yes, the fire rises.